Welcome to Breaking News to Trading Moves. Today we're looking at a specific market action, the recent Nasdaq debut of Cardinal Infrastructure Group.
Yes, and this is a good case study of how the market reacts to a new company in a hot sector. We're not so much focused on Cardinal's long-term plan here.
Right.
We're tracking the immediate aftermath. Where did that positive feeling and all that new capital actually move the needle for other companies?
That's what we're here to do. Break down that immediate market reaction and identify the public companies that seem to gain, or, on the other side, the ones that face new pressures. We're just following the money.
So to set the stage, let's talk about the company itself. Cardinal Infrastructure Group. Their ticker is CDNL.
CDNL. Okay, and what's their business?
They're a construction and site services company, and they specialize in what's called wet utilities.
Wet utilities. So we're talking water and sewer systems.
Exactly. The really critical, foundational municipal work, the kind of stuff that just can't be deferred. And that stability is a big reason Wall Street was paying attention.
And that attention definitely played out in the debut. What did that look like, numbers-wise?
The company listed on Nasdaq, opened strong. It debuted at roughly 9 to 10% above its IPO price of $21 per share.
And that valued the company at what, right out of the gate?
Right out of the gate, that move put the valuation at about $842 million.
Okay, valuation is one thing, but the cash they raised, that's what really impacts the competition. How much did they bring in?
The IPO raised approximately $241.5 million.
Wow.
And that cash is, well, it's set aside for two main things: funding growth and also, very importantly, paying down their existing debt.
The fact that an infrastructure IPO did so well right now, that says a lot about the market's general mood, doesn't it?
It absolutely does. It shows there's a strong appetite for infrastructure for these domestic construction names.
And that's tied to expectations about the Fed.
For sure. It's supported by the idea that the Federal Reserve will eventually cut rates, which tends to help these big capital spending cycles. And, the U.S. stock market has a pretty healthy backdrop in general right now.
So when the market is looking for growth that's tied to real, tangible spending in the country, a company like CDNL gets a lot of looks.
It gets attention instantly.
All right, let's get into the moves. The IPO was a success, and that confirmed for investors that the whole infrastructure theme has legs. So where does that capital flow first? Let's start with the most direct beneficiaries, the established construction contractors.
Correct. And the logic here is pretty straightforward. It's about validation. If investors are willing to reward a new name like CDNL so warmly, it's a positive signal for the established leaders already in that field.
And who's the main example of that?
You'd look immediately at a company like Quanta Services, ticker PWR. That's PWRR. They're already a huge player in energy and utility infrastructure construction. They're set up to benefit from the same theme of multi-year investment in grids and utilities. CDNL's successful IPO just confirms that Wall Street wants exposure to these kinds of long-term infrastructure stories.
Which helps support PWR's valuation.
It supports valuations across the group.
Okay, so PWR gets a boost from the validation. But isn't there a risk that CDNL, with all its new cash, starts to compete with Quanta on smaller jobs?
That's a fair question. But for right now, the thinking is that PWR's massive scale is a kind of buffer. CDNL is mainly a wet utility specialist. PWR is much broader.
So the immediate reaction isn't about competition, it's about the whole sector looking more valuable.
Exactly. It's a rising tide for valuations before the direct competition really begins to heat up.
Makes sense. Okay, let's move past the big general contractors. What's the second category of companies that benefit here?
This would be the specialists, the engineering and utility service specialists. CDNL's strong debut reinforces the idea that governments and utilities are going to be spending consistently for years to come.
And who are we looking at in this group?
Companies like DICOM Industries, ticker DY, that's DY, and also Primoris Services, ticker PRIM.
PRIM. Okay, so DY and PRIM. What sets them apart?
Well, they focus on more specialized work. Think telecom, power, civil projects. They're already established. They're ready to take on more demand.
So as money flows into the broader infrastructure upgrade idea,
stocks like DY and PRIM catch a tailwind. Investors look for these established, liquid ways to play that theme. CDNL just confirms the whole thesis is working, so capital moves toward the existing experts.
All right, now for our third group of winners, let's move even further down the supply chain, away from the companies doing the work to the ones providing the raw materials.
This gets us to aggregates and construction materials. And this link is fundamental. More funding for contractors automatically means more demand for the physical stuff that makes up roads, foundations, and, utility trenches.
Who are the big names we should think of here?
The primary examples would be Vulcan Materials, ticker VMC, and Martin Marietta, ticker MLM.
VMC and MLM. The stone and gravel giants?
That's them. They supply the construction aggregates. A healthy pipeline of infrastructure jobs supports steady volumes. And this is key pricing power for these suppliers.
They're sort of the purest play on just more activity?
Exactly. They don't have to worry about which contractor wins the bid. They just sell more rock.
Okay, that paints a clear picture of the beneficiaries. You have the big contractors, the specialists, and the material suppliers. Now, let's flip it. Let's talk about the areas that might face some pressure from this.
Right, because $250 million suddenly showing up in a competitive field. That has consequences. It creates new competitive pressures, or it causes capital to just move around based on a new risk-reward calculation.
Let's start with one that might not be so obvious. The large home builders. Why would they feel any pressure?
Here we're talking about Lennar, ticker LEN, that's LEN, and D.R. Horton, ticker DHI.
DHI.
Home builders are in a unique spot because they depend so heavily on third-party contractors, companies just like CDNL, for all that crucial site work.
The utility hookups, the land prep, all that.
All of it. So CDNL, now armed with IPO cash, can invest in better equipment, they can hire more skilled crews, maybe they can bid more aggressively for talent.
Which means they don't have to cut their prices.
Exactly. And if the general cost of site preparation and utility installation goes up even a little because of this new well-funded competitor, that translates directly into higher build-out costs for the home builders.
And what does that do to their margins?
Home builder margins are very sensitive. Even a 1 or 2% increase in subcontractor costs spread across thousands of homes adds up fast. It puts a sort of gentle but constant pressure on their gross margins. LEN and DHI are well-run companies, but in this specific scenario, they are cost takers, not cost setters.
That's the operational side. Now for the direct competitive pressure. Who gets hurt the most by CDNL's new war chest?
That would be the smaller regional contractors, the ones that typically operate with weaker balance sheets and less access to capital.
Companies like Construction Partners, ticker ROAD.
Yes, ROAD is one, and also IES Holdings, ticker IESC.
IESC.
And the reasoning here is just about scale and money.
It's purely about that. When a competitor suddenly has hundreds of millions in fresh capital, they have an instant advantage. They can look at buying smaller peers, they can get better financing terms on equipment, and they can attract the best workers with better pay.
So investors start to lean toward the bigger, better-funded players. That's the idea. They start to favor these scaled platforms, and that can make the smaller players, like a ROAD or an IESC, look relatively less attractive. They're left trying to compete against a rival who just got a massive head start with that IPO money.
That capital creates a new hurdle for them. Okay, finally, let's talk about the third category. This one is less about direct competition and more about how money moves around the market.
Right. This focuses on the classic defensive utility stocks, especially in what we'd call a risk-on environment.
Can you explain that risk-on idea and why it's a negative for utilities?
We're looking at stocks like Duke Energy, ticker DUK, and Southern Company, ticker SO.
DUK and SO.
Utilities are what you'd call income-oriented holdings. They offer stability, steady dividends. They're what portfolio managers buy when they're feeling cautious. A risk-on tape just means the market is feeling more confident and investors are looking for more growth potential, not just stability.
So a successful IPO like CDNL is a signal that growth is back on the table.
Precisely. When cyclical stocks and new IPOs are performing well, it's natural to see a rotation. A fund manager might trim a position in a defensive name like DUK or SO to free up cash to put into a higher growth construction name.
So it's not a knock on the utility company itself.
Not at all. It's just a reallocation of capital. The utility becomes the funding source for the new growth trade.
This breakdown really clarifies how a successful IPO is about more than just one company. It's a signal to the market that reveals who's in a good position to benefit from that theme and who might face some new challenges.
The market's reaction is a quick way to gauge sentiment, and CDNL's debut gave a very clear reading on infrastructure.
So what's the final thought here for you? Well, consider how major infrastructure spending always creates these different tiers of beneficiaries. You have the firms doing the work, the companies supplying the materials, and then the organizations that have to adapt their own costs to compete. The real question isn't just who benefits today, But you have to wonder if Cardinal's choice to pay down debt so aggressively means they're bracing for a potential slowdown, while others are just assuming clear skies ahead.
And of course, we have to end with our standard note for everyone listening.
Remember, this analysis is purely the opinion of the author of the material provided. This is not financial advice or a recommendation to buy or sell any security mentioned, including CDNL, PWR, DY, PRIM, VMC, MLM, LEN, DHI, ROAD, IESC, DUK, or SO.
Always consult a financial professional before making any investment decisions.